Good morning, everybody. Happy Tuesday. My name is Gareth Soloway, Chief Market Strategist here at Verified Investing, and this is my trading game plan. So, as always, folks, no BS, just charts. That's what we're going to focus on, charts and data. And getting right into the action, let's take a look at where the markets are this morning. So if we take a look here, we have the S&P basically trading slightly higher, but notice again at 4 in the morning, we had this nice little rally up and then a fade slowly back down throughout the course of the morning. And this is the 10-minute chart on the SPY. We're using the S&P tracking ETF today because of a contract rollover with the E-minis. It's a little bit skewed, but nonetheless, the S&P here, the SPY showing us a pretty accurate view of where markets are. So if we look at yesterday, where did we close? We closed right here, 660.84, and we're trading currently at 661.45 or so. So again, 60, 70-cent gain on the SPY. That equates to 6 to 7 points on the S&P 500. Now, there are some keys here. So number one, when we flip over to this chart, we have to look at where our wedge pattern is. Our wedge pattern that we've been following, yesterday we did close above it. Now, a lot of people would jump the gun and say this is a breakout. But if you followed me for more than a week or two, you know that we look for confirmation of a move. So what I'm looking for today is, can we confirm the breakout? We would need a close above 66.21 to confirm that breakout. Based on where the markets would open today, we'd be right at that level. So we'll have to watch and see how markets react. So that's number one on my radar for the S&P today. And again, always remember, the reason I came up with the confirmation signal is because as a younger trader, I got so sick of getting whipped out of trades. I would think it was a breakout and jump on board, and then price would go the opposite way. I think it was a breakdown. I'd exit a long position thinking, oh my goodness, it's breaking down, and all of a sudden price would turn back around. And what I found was, when you look for confirmation and you get confirmation, the probabilities of it being incorrect in terms of a breakout or breakdown are dramatically reduced. So again, remember, everything we do in the charts here is probability based. It's literally based on 26 years of me trading and making lots and lots of mistakes early in my career and still making mistakes to this very day. But the idea is that over time and doing thousands, hundreds of thousands of charts at a time, looking at all of these charts over that amount of time, you start to understand the probabilities of a move. All right. So let's get into it here. So this is the next big thing I'm watching. So yesterday we talked about this beautiful parallel. Now you're going to say, well, this isn't a parallel. This is a trend line. Don't worry. We're going to break out the parallel in a second. But I wanted to show it for those of you that are new to my trading game plan, the simplicity of a trend line. So this high pivot right here on the QQQ from February was your previous all-time high. And I'm zooming back or zooming out so you can see. This was your highest peak, even higher than this one, before your Liberation Day sell-off down into early April. And so that becomes what we would call a significant pivot high. It was the highest point on this side. Literally, it was years in the making. And then it would add a subsequent almost 20% sell-off in the S&P before rising and making new all-time highs. So that's one of the reasons why you choose a point like that to draw a trend line. You then take that trend line, connect it to your previous highest point, and lo and behold, we went right up into that yesterday. And remember, I was kind of speculating that that's what we needed to see, right? That was what the market was going to do. It was going to bring the NASDAQ 100 up into this trend line. Then we would see how the markets react. And again, I was just speaking about parallels. And so if we drag the parallel down, this was that next level on the parallel, right? You have pivot low, pivot low, pivot low. And then what's so interesting here is, look at this. If we drag this further to the downside, look at this. High pivot, low, and low. And this is how you confirm you're right on with a parallel, is you bring it down and look, low, and then it kind of chopped, broke down, came underneath, gapped above, and then it became support right there. And so again, the point being is that generally when you find an accurate parallel on the charts, it should work with multiple points, right? So you have the one parallel you're looking at, but if you bring it up or down, it should coordinate with other major pivot lows. And it's a great way for those of you that are newer to really decide whether or not you found an accurate parallel, right? Because if you drag it up and down and it doesn't have any other pivot points at any other point, then you have to say, okay, is this as significant as I think? Or maybe I need to see if there's a different parallel in here. All right. So again, little tidbits of knowledge that, again, I figured out over long periods of time. But suffice it to say, the QQQ is into this level. We will be opening up slightly on the QQQ today as well. We'll watch and see. Now, this next segment, guys, I was doing some research this morning. I got up really early in the morning. I get up generally between 5 and 6 in the morning. I start scanning the markets. My general routine is to really see what is moving for the day, what's the economic data, what is the levels or what are the levels on the charts. And that's really how I'm able to bring it into the game plan and then utilize this information throughout the course of the day to make money as a day trader and swing trader. But I was looking at the charts and I was like, is there any sort of kind of parallel, not in the chart parallel sense, but to the financial crisis? And something I found was worth sharing with you. And I always share with you. If I find it, I share it with you. It's just like, from here right to you guys. Now, what I'm going to show you here is very fascinating. If we bring it over to the charts again, what we're now looking at is the current market right over here, okay, with 2007 top, right, before the financial crisis. All right, so again, this is the lead up to the financial crisis, and this is the lead up to the current period. And what I found is that if you look back and you see where housing prices topped prior to the financial crisis, they topped between 2 and 2.5 years prior to the market topping. In addition, look at the date of the first rate cut in 2007. Now remember, the markets were at all-time highs back then. It was on September 18th, 2007. And even when they cut rates, did the markets go up? Well, maybe a tiny bit. And then look at what ensued after that. Okay? So again, 2 to 2.5 years prior, housing topped. And then the Fed cut rates in September 18th, 2007. And we see what the markets did. And then if we go here in early 2023, the housing market topped. Now, listen, in different areas of the country, it might have been off by a few months, but in general, housing has topped. And in fact, if you're in Florida, you know how bad it's gotten. Literally, I have real estate brokers telling me it's as bad as 2008 in the housing market in Florida right now. But suffice it to say, housing topped right here. And 2.5 years later, where are we? We're currently at that point. Look at what we're expecting tomorrow. First likely Fed cut. And look at the date. Is that spooky or what? September 17th, 2025. And so my point is there's twofold. Number one, the point is that the housing market tends to lead these bigger financial crises because people's homes are their biggest asset. Okay, so when the house starts to decline, what does the consumer do? The consumer says, oh my gosh, my house was worth $600,000. If I wanted to sell it today, it's only worth $400,000 or $500,000. They feel, even though it's not in real dollars, it's in their home, they still feel that financially. They say, wow, my net worth is not as big. And it causes the consumer to pull back. Now, what's interesting here is we did not have inflation that was as high as today. And that's an added negative, in fact, stagflation. But what's interesting is you had the same labor market factors too. So during this period, we saw the labor market weakening, housing prices topping, and then the Fed comes out and cuts. And that's exactly what we are seeing right now. Now, listen, is it going to be a financial crisis like that before? We honestly don't know. I can only draw parallels and give you guys information, and then we'll watch and see. But my goal here is to kind of open your eyes, right? The one thing I've never wanted to be in my life is the person that puts my head in the sand and says, hey, I don't want to know anything. I just want to believe what I want to believe. I want to know everything, and I'll make my own judgments on what I want to go with. and this is information. Information should be readily available to all of us, and we make our own decisions, right? We're big boys and big girls. We make our own decisions. Okay, so back to the charts. Very interesting chart on that front. The only other thing that I would like to just share with you guys before we get into more charts is this chart that's very concerning as well. And this chart, my friends, is basically the delinquency on credit cards, 90 days delinquent or more. And this is very unnerving because if you look back, all right, and we look at these numbers, you're basically trending to levels that you haven't seen, that literally you have to go back to the 08 period. When was the last time? The financial crisis was the last time we saw numbers this high on delinquencies, and you're actually approaching 1999 and 2000 levels. And again, by itself, does that make us like, say, oh my goodness? No. But my point is, again, we look for breadcrumbs, and that's what a good investor and trader does. We're really a good trader and investor, and I share this with you because I want you guys to learn how to be this, is that we're investigators. We're investigators, right? We're not the type that just blindly follow the hype on social media. In fact, I would guarantee that if you are watching my game plan and you're one of the followers of Verified Investing, you probably spend less time on social media and more time looking at charts and ignore that kind of stuff, because we know that it creates emotion, which then makes us make wrong decisions. And so ultimately, we're investigators. We look for different factors and we go from there. All right, so let's continue on our merry way today on our normalized chart analysis. I just wanted to share that with you. But if we look at the DXY, which is the dollar against a basket of currencies, I've been bearish on, saying we're going to go lower, likely to this lower zone here, which goes back, by the way, to 2008. And so all of a sudden, a lot of things we're going back to 2008 on. Right now, listen, we're not at those lows on the dollar, but the point being is what I've said is there's going to be support at this trend line that goes back to 2008, or this trend zone, and we're going to watch. And if this breaks, then eventually history shows us we find our way back to those lows, which would be 71 on the Dixie, on the DXY. That is incredible to even think. Even for me, that's pretty astounding to think that the dollar could be going back there. Now, what's the culprit of that? What is the culprit? Well, I've said this before, but it deserves recognition, is that, more and more countries are looking to diversify away from the reserve currency, the dollar. And listen, the dollar won't be all of a sudden not the reserve currency. This is a process that takes a decade or more to do. But what the U.S. has done is it's tried more and more to exert its power and make other countries do things, right? Whether it's tariffs or whether it's, other political kind of maneuverings, whatever it may be. And because the dollar has so much impact on these other countries as the reserve currency, it gives the U.S. an over amount of power over other countries. And other countries aren't liking that, right? In addition, other countries are looking at the U.S. debt. They're looking at the amount of treasuries that they own, and they're saying, we don't feel so comfortable being so beholden to what the U.S. does. And just to give you guys a sense, is if the U.S. were to go into a financial crisis, because the rest of the world is so reliant on the U.S., the whole rest of the world would go into a financial crisis. Like, that's how much, again, holding treasuries, holding all this other, trillions and trillions of investments in the U.S., it basically would create that type of situation. And that's making, because these other countries are viewing the U.S. debt and how high it is to GDP and how it's not being gotten under control, even by the new administration, that is a concern that they have to recognize and diversify against, okay? So if we go here, we go over to the 10-year yield. The 10-year yield, we could see, again, there's this beautiful trend line that goes back to August of 2022. And if we look at this, we've now broken below it, and we're starting to make bearish consolidation. And that, to me, again, it's not about the Fed cutting rates. What this tells me on the long end, because remember, the Fed controls the short end, which influences the long end, granted. But this is now telling me that the economy is absolutely weakening. Okay, so again, if yields are going to go lower, it's not because the Fed's cutting rates on the 10-year. Chances are it's the economy weakening. All right, let's flip over to some stocks. This is one of the big ones here, Oklo. This is kind of a nuclear power kind of playish that's been very, very hot. Take a look at this trend line that was hit yesterday, right here. Interesting trend line, big move up. I do think it's down a little bit this morning, but if it pushes up to the 100 even number, I'm going to be looking for a short today. All right. So again, watch that even number of 100. Again, it may not get there, but if it does, that's going to be an interesting one. Here is a chart on GE. Now, GE Aerospace has been, honestly, it's kind of put, in a way, it's put the, NVIDIA to shame, right? Because of this incredible move up. I mean, just one of the best moves for the ages over the last few years, going back to 2022. But look at what it's approaching, double top. Now, as a swing trader, that is extremely interesting because, again, this is double top from 2000. So we're not talking about like double top from a month ago. And one of the things in technical analysis for educational purposes is that when you look at double tops, the further back you go, the more significant psychologically they will have as an impact to investors. All right. Now, again, it might be subconscious, as it often is, but a double top from 2000 is big. That's much bigger than a double top from a month ago, right? A month ago, okay, big deal. It was, here it was a month ago, here it is now. Maybe you get a small pullback and then it goes higher. Double top from 25 years ago, that's big. That is big psychologically. All right. So keep an eye on that. A couple stocks that I'm watching here. These have had amazing moves. Seagate Technology is a chip stock. And again, had a big move yesterday, but look at these trend lines that it's run into. A lot of resistance around $215. WDC, one of my favorites for a pullback here, is look at this parallel. Beautiful parallel right there. And again, you could see yesterday it did push up, pierce that parallel, and retrace a little bit. So we'll keep an eye on that. Now, gold. We got to talk gold, guys. Because gold, I did a special update on my channel yesterday on gold. For those of you that want these shorter kind of in-depth videos on individual things, that's where you'll find it on my channel. Here on the Verified Investing YouTube, we do our shows, our hardcore shows like the My Trading Game Plan. But this trend line is still intact, but look at this. Look at yesterday's close on gold. If we take this line, did it close above the topping tail high? The answer is yes. What does that mean? It means that this is no longer a power factor. All right, so the bearish topping tail has now been negated. And again, as a technician, that is information that you want to know. What that does is it takes away the bear case in the near term. Now, listen, you could still make the case that, okay, yes, that got taken away, but you still have this upsloping trend line, which is valid because notice the pivot low to the pivot low, and then it broke down resistance. So see how it behaves at that belly. So we still, and even here, that's what was rejected. But my point being is the bear case on gold went down from 2 factors to now just 1 factor. I almost put up the wrong finger there. I apologize on that. But the point being, again, is that is now less likely. So if you look at probabilities, when you have 2 factors, probabilities are like 65, 70% chance of a pullback. When it's just 1, maybe 50%, 55% favoring. So it really does affect probabilities. And as a trader, if you are a trader that pays no attention to emotion, which is ideally what I'm conveying here, then you have to pay attention to that. That's a factor that has now been negated. Now you still have the trend line, and gold is short-term extended, but that's it. That's it. So maybe it favors a small pullback here slightly, but maybe it's just 50-50 at this point. Really important information. All right, let's look at silver. I still am bullish on silver, and it keeps grinding up. Again, silver broke out classic river theory right there. Consolidation, move up. Again, I'm not saying it's going to go straight to 44, but 44 is your next stopping point on silver, and if it breaks that, you're looking at $48 to $50. Next up, let's take a look at oil. And don't worry, we'll get to Bitcoin. I'm not going to forget Bitcoin, folks. Here's your oil chart. Again, I was kind of getting rid of all of my trend lines, but we can put them back in very easily. That was your bear flag consolidation, breakdown, retrace to the scene of the crime. And then since then, really, we still haven't hit my ultimate target, which makes me think, by the way, the more you kind of dance around a target like this downside target, gap fill, the more likely when it comes down there, it actually could break lower. So just be very careful there. I was originally thinking about buying at the gap fill on oil. No way, not anymore. Now I'm probably looking for your double bottom here. All right, or triple bottom at that point. Then natural gas, if we flip over to nat gas real quick, We take a look. Nat gas is back above this trend line, potentially looking to confirm today. Didn't confirm here, faked people out, brought it back down. Now it's closed above. Can it confirm the breakout? If it does, it opens the door to a move to about $3.50, $3.60 on natural gas. Now, lastly, Bitcoin, guys. Bitcoin continues to dance at the underbelly of this 117,000 level. This pattern is not a bad pattern. It's not perfect by any stretch, but it's not bad either. And again, for now, I'm going to give it the benefit of the doubt. As long as the market stays strong, we can make a case that this is a bullish pattern that could be setting up to break out to the upside. All right, now listen, I want to call a spade here, and this goes for the whole entire market. Tomorrow at 2 p.m., we're going to hear from the Fed. They're going to cut rates by 25 basis points. It just is what it is. The key is going to be what they do or what Jerome Powell says. Is he cutting as a Fed chairman, as the Fed, and is hawkishly cutting, or is he dovishly cutting? And the dovish chatter or hawkish chatter is going to be the determining factor if the stock market goes up tomorrow and the next few days, or if it sells off. And my guess is Bitcoin will follow suit. And the idea is, again, Bitcoin still generally trades as a risk asset. So we have to keep that in mind. All right, lastly, folks, as always, I want to go over some questions that I get from you guys. I love that you guys post questions up. First question is, can you review the chart of SoFi? SoFi, sure. And by the way, SoFi is one of these buy now, pay later. And when you see the credit card delinquency rates I showed earlier on, while SoFi and Affirm have done well, this is a warning sign, absolute warning sign, okay? Eventually people stop. Listen, if you buy something and you only have to pay a portion of it, do you think that once you lose your job or once money's hard, are you going to really continue paying for that? No, you're not. And so these companies notoriously, by the way, and I've said this before, I don't know if I've said it to you guys, but I've said it to the traders in the room. When buy now, pay later does its best, it's right before a crash or a collapse in the market. Why? Well, because more people are choosing to do buy now, pay later because they're struggling. And that means these stocks do really well. They have great earnings reports. But once things get too bad, then people stop paying for that buy now, pay later, and then those stocks have a massive collapse because they're on the hook for a lot of those losses. All right, so in any case, to go to the charts, let's go to the charts and take a look at SoFi. But just keep that in mind. I have a former, so I had this trend line. We can see it broke above, consolidated, moving higher. We can get rid of it for now. But what's this other trend line I had here? There you go. Oh my gosh. This looks like a great swing short if it gets up to this level. 28.30, 28.25, double top from 2021. By the way, in what happened after 2021? Do you guys remember? We had the bear market in the stock market. Look, it was at its highest point in 2021. And then look at the collapse. And so I just was telling you guys about how that works. And then all of a sudden we look at SoFi and it literally is mirroring that. And isn't that kind of spooky? That just before the bear market of 2021, and look, price is back to that high almost. That's pretty freaky. All right, so in any case, to me, this would be a great swing short at double top if it gets up there. All right, let's go to another question here. If I could go over, I would appreciate if you could go over Eli Lilly. Sure, let's take a look at LLY here. LLY, see what we got. LLY, let's go to our daily chart. Daily chart hit this great support line. You can see I had these lines already drawn in for my members. And again, right there, beautiful bounce. Now it's filled this gap. There's one more gap up here. I don't really have a great read on this. The one thing I am seeing here is there's a trend line. There's a trend line here. So if price gets up to about 776 or 776 or so, there's going to be a downsloping trend line and a lot of resistance there. Not to say it can't break out, but that would be a level that I'd start to be a little nervous. I mean, honestly, this has had a big rally, right? So just be a little careful, especially as more and more competition comes in for the weight loss drugs. We'll do one more question. We'll do Wolf Speed. So Wolf Speed, guys, has had an impressive move. If you're a member, by the way, of Smart Money Stocks and ETFs, Drew, one of my top traders, Drew, who runs the small cap service within Smart Money Stocks and ETFs, he played Wolf twice in the last week for like 20% gains each time. He's crushed it on that stock. So great job to Drew out there. But if we go back to the chart, it's had a great run. It's gapping up. It's catching that fire. Be careful, and I'm going to tell you why. So based on them filing for bankruptcy, this company, all the shares that are outstanding right now, those shareholders are only going to end up owning 3 to 5% of the company. Now, listen, the company obviously it's valued only at 400 million, so or 500 million or whatever it is. So it's very cheap, and maybe that's okay. But for me, I have to multiply that market cap by 20 times to get to 100%. If it's 5%, 5 times 20 is 100%. And so I have to ask myself, is Wolfspeed worth $10 billion? I don't know. I'm not sure about that. That's tough. That valuation is starting to get a little rich. And again, this is just part of the bankruptcy thing that happened, is that the deal with creditors, people that they owe debt to, was that they would get, basically the debtors get 95% of the company. And so I'm not, again, that's being slightly factored in, but it does make me nervous until I get more clarity on the stock. So listen, the easy money, essentially, I would surmise that the easy money has been made at this point. Now listen, in this environment we're in, could it run up another $1, $2? Sure, it could. But be careful. This is one where at a certain point it doesn't make sense, and you will see dumping going on, maybe even institutional, from those that get the other portion of the company. All right, guys. On that note, I've got to get going here, back to my live trading room, doing some day trading today. You guys have a great morning, and thank you guys from the bottom of my heart for trusting us, for being with us. By the way, share this with a friend. If you've got friends and family that are like struggling and like thinking the markets are all gravy and they're all invested and they're levered to the hilt, share this. If I can save a few people when we get that collapse, like, that 30, 40, 50% drop in the market, if I can save them a little bit by just bringing some of this stuff that I showed you guys to their attention, I'll have done my job. And if I can teach you guys, then I've done my job. So have a great one, guys. Thanks again for your support. We love you. I'll talk to you soon. Take care.